September.
Changing the balance of risks from squarely on inflation to a more balanced set that also include what we're seeing in the labor market, which seems to key off the market's conviction that they're going to go in September. What I find interesting is that this market is pricing in more than one rate cut in September, which raises the question about whether the market's ahead of itself or whether they're seeing something that the Fed is not.
I think we all heard the same thing just yesterday. HSBC cuts are on the table. BNP Paribas was setting up September. Bank of America, we're not quite there yet, but Morgan Stanley says cuts are coming. What's the difference between now and September? It's this calendar right here. So we've got payrolls tomorrow morning, then we've got CPI on August 14th. September 6th, we've got another payrolls report. September 11th, another CPI report. Then about a week later, you get another Federal Reserve decision. Lisa, they are the next 4 big data points for this Federal Reserve.
What I thought was interesting was that Jay Powell seemed to have been listening to us. I will just suggest, not us, but a lot of the wonderful commentary that he welcomed getting from all of the different analysts, basically the idea of the difference between data dependency and data point dependency. It seemed like the totality of data seems to be suggesting that they are going to go in September, and it would take a pretty significant aberration to really move away from that. That got people's attention. What is less clear is the idea of proactive rate cuts, sort of going ahead of weakness being visible in labor markets. That I didn't get a clear answer on.
There was a small, subtle nod to the labor market cracks that we've started to see, and it was in the statement, but it was small and it was subtle. And in the news conference, I have to say, he didn't put much weight on it at all. What did you think of that? Sort of acknowledging the SARM rule a little bit, but then moving on from it and shrugging his shoulders, saying that this time is basically different. I also thought it was interesting the way he characterizes the inflation shock of the last couple of years. He basically said it was transitory without saying it was transitory, which makes me think that they don't think we're in a new regime at all for inflation.
Jay Powell does not seem to think that we're in a new regime, and we've seen that just based on what their neutral rate has been in their projections, in their statement of economic projections. It hasn't been as high as the market expects it to be. What I think is notable is how much he was trying to reflect a consensus, and how it really was interesting that he gave a nod to the idea that they even did discuss potentially lowering rates at yesterday's meeting. There clearly is a divide on the consensus, the sort of wrangling of cats. Let's see how that works heading into September.
What you just said, I think, is important, and it was echoed by Evercore and Krishna Gua. We mentioned this in the program yesterday. If you missed the program after the news conference, Krishna Gua over at Evercore had this to say: we think in practice it's not very data point dependent at all. We view the cautious evolution of the statement as intended to carry hawks along and avoid dissents, as was intended and indeed the case today. Expect a clear signal a month from now at Jackson Hole. And Jackson Hole, maybe the stage is set to take that next step towards September.
You know, we were talking about that yesterday with Rich Clarida, and he seemed to say, well, it probably isn't going to be that different. That is the perfect time for them to set up some sort of narrative of what the threshold is for them to cut rates and what that path could look like. To me, there is a distinction, and we've been talking about it for several months now, about cutting rates in a good circumstance and cutting rates in a bad circumstance. Last month, we saw a massive outperformance in the Russell 2000, which would be coherent with rate cuts for the right reason. Really, what I think, and what I've read in all of the notes between now and September, is going to be, is it going to be for the right reason or is it going to be for the wrong reason? And that, I think, is going to be what remains to be seen.
This is why the jobs report is so important. Both jobless claims a little bit later this morning and payrolls on Friday. If you are just joining us, welcome to the program. Equity futures on the S&P with a little bit of a lift. We're up by 1/3 of 1%. I have no idea where July went. The whole thing was a blur, but hello, August. Yields are higher by a couple of basis points on a 10-year, 4.0564%. It was interesting how much 10-year yields just sort of gap lower going into the close yesterday, Lisa, following that presser with Chairman Powell.
Yeah, especially at a time where it seems like they are willing to make a move, and it's a process of cuts from there. Just to put it into perspective, 10-year yields on the month of July were lower by 37 basis points. 2-year yields were lower by 50 basis points. That is a dramatic shift lower in expectation, which is part of the reason why the Russell 2000 was up more than 10%.
Big rally at the front end of the yield curve. More on that a little bit later. Coming up this hour, here's the lineup for you. We'll catch up with Jack Caffrey of JP Morgan Asset Management as expectations for Fed cuts drive stocks higher. Scott Devitt of Wedbush following Meta's upbeat earnings report, and John Lieber of Eurasia on rising tensions in the Middle East. We begin with our top story, flipping the calendar to August. August with the stage set for September. Fed Chair Jay Powell opening the door to a rate cut next month, sending the S&P 500 to its best day since February. Jack Caffrey of JP Morgan Asset Management with this to say: in a soft landing, there is more growth to go around for more companies, and overpaying for it is hard to justify. The realization that there can be more growth to go around also suggests that stocks that have been avoided for fear of a recession can offer more opportunity to see positive EPS revisions. Jack, I'm pleased to say, is with us around a table here in New York. Jack, good morning.
Good morning.
Are you validating the move we've seen in small caps and elsewhere outside of big tech?
I think we're validating the move that we've moved from a market that was just the Magnificent Seven to the S&P 500 to increasingly smaller cap stocks. So investors are leaning into more risk, if you will, because I think, as I tried alluding to, when you're less worried about there being a recession, you don't need to just worry about businesses that can grow regardless of the economic environment. That then makes you, I think, more valuation sensitive, as you actually wind up having more things to start choosing from, and you do actually have to get the right business at the right price rather than just owning something you have confidence can actually deliver earnings growth.
It begs the question whether we should be less worried about there being a recession. What is the reason for that?
It does feel to some extent like the Fed has managed to stick the landing. You know, I've been here several times over the course of the last year, and we started talking in January. There was a sense we could see 5, maybe 6 rate cuts this year, and that there was going to be some massive decline in economic activity that was going to prompt that dramatic monetary policy shift. Now it feels like we're getting increasing confidence that we'll get to sort of 2% inflation, which should be a safer environment. Companies get a little bit of pricing power, but it's not scary to the consumer. It doesn't perhaps trigger changes in consumption patterns, and you actually end up having some growth. We might go more to a terrific 2 sort of growth, which might be able to maintain some stability. And so you have a Fed that shifts from being data dependent to, I think, looking to, we've done it. It's hard for them to declare victory because their forecasting record has been uncheckered by success in the past, but one where I think that things are lining up to be more positive than not.
The investing framework, I want to dig a little bit deeper, not just into the idea of leaning into risk, the rest of the S&P 500, small caps, but valuation sensitive. Are you basically saying that right now big tech still looks overpriced, and that is going to continue to underperform as the rest of the universe starts to look more appealing?
Well, when you have 7, 8 stocks effectively being 25% of the market, those stocks can go sideways, and you don't have to sell very much of them to actually see some really big gains in other parts of other individual stocks. You know, you look yesterday, you end up seeing a whole host of really different businesses had great years, all between 9/30 and 4. 12, 13, 14, 15% gains in independent power producers, online dating companies. Oh yes, and AI semiconductor names had similar moves, but you didn't have to see a lot of selling in some of those mega cap names, those Magnificent Seven names, in order to see whole hosts of other sectors actually participate in the rally over the past several weeks.
So right now,
rally under the curtain, if you will.
So right now it sounds like you think that this really is sort of the Goldilocks that everyone is talking about, that it's rate cuts for the right reason, correct?
Yeah, I mean, sorry.
No, so then what would make you think it was something else?
Talk to me at 8:31 when we actually start seeing what the initial claims start looking like. Do we actually start seeing some real shift and reacceleration that perhaps, I was trained by monetarists 30-odd years ago, and monetary policy operates with long and variable lags. I think we should probably apply the same metric and rubric when we think about employment, in terms of employment results operate with long and variable lags. We are in an election season. There have the possibility of very real policy shifts next year. And if one of those involves removing large portions of a population of the United States, what does that mean for consumption? What does that mean for labor force availability? How much do you have to pay somebody to go make beds in a hotel or a hospital? If the typical workforce that might have done that job in the past is no longer available to you. So I do think that we have some things that I can sit there today and say, wow, the economic data that's backward looking says I've come to something much more stable and Goldilocks-like. But at the same time, I do think that we have real possibilities of policy shifts in the forward. And I think companies do tend to sit on their hands when they're faced with uncertainty around what their tax policy looks like, what their cost structure looks like. And, you know, 200 years ago, we talked about tariffs. Now we're talking about tariffs again. Oh, I know what those are called in today's parlance. Those are called VAT, value-added taxes, or consumption taxes. So it's sort of interesting that we might have some fairly large policy shifts. I'm not sure how to handicap that because
well, that's what's difficult. You know, I wanted to ask you that question. These are incredibly complex issues that are potentially on the horizon, but with the emphasis on potentially.
Yeah.
What do you do in between?
Don't overpay. I mean, I think it comes back to when you're faced with things that are hard to quantify, hard to qualify, it comes back to this idea of, I want to be more valuation sensitive perhaps than I have been in the past, because the frame of reference that I have to worry about is not what does the initial claim look like on Thursday, it's will that be a relevant statistic in 6, 9, or 12 months from now? And we saw an evidence of that in 2018. We changed tax policy that was supposed to drive an investment boom, and we started a trade war, which halted an investment boom.
Yeah.
So when we come back to this idea of there are difficult things that we have to incorporate into markets, some of that can be done probabilistically. Some of that is, I can't put, is it a 5% chance, a 3% chance, or a 15% chance? What I can say is I'd rather own stocks that are cheaper, that have lower expectations, and that have a better chance of beating low expectations and saying, I want to look on companies where I have high certainty of success, but I have to pay an exceptionally high price for that seeming certainty.
You mentioned 8:31, just for our audience, 8:30 is when we get jobless claims, a little bit later this morning, then tomorrow, 8:30 Eastern time, we'll get the payrolls report as well. Before you go, I wanted to give you a bit of a shout out and some credit. Coming into summer, you made the point that maybe this AI theme was overextended. I remember the conversation around the table, and that theme had some difficulty, with the exception of the $329 billion rally that NVIDIA delivered just yesterday. July was a tough month for some of those names. How do you think we've sort of reset things now? How do you view that story at the moment?
You know, I think we've seen those companies which are committed to AI are still spending in support of AI. And whether you heard that from Microsoft 2 days ago, whether you heard it from Meta last night, I do think where you're going to see more focus today and going forward is starting to see proof statements for how AI is driving revenues and, more importantly, ultimately driving profit. Because right now, you're seeing consultants talking about AI and making money off of AI, but we're talking more, I need proof of concept or delivery of concept. And I think it's that second order, which is supposed to be the massive unlock, and we're still waiting for show me. Show me that money, not the money which goes into the hardware that makes it all possible. Show me what you can do with it.
Jack Caffrey, it's good to see you. Thank you as always. Jack Caffrey there of JP Morgan Asset Management. Equity futures just about positive as we kick off August. We're positive by 1/3%. Let's give an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Former President Donald Trump questioned Vice President Kamala Harris's racial identity at a contentious roundtable at the National Association of Black Journalists.
I've known her a long time indirectly, not directly very much, and she was always of Indian heritage, and she was only promoting Indian heritage. I didn't know she was black until a number of years ago when she happened to turn black, and now she wants to be known as black. So I don't know, is she Indian or is she black?
Kamala Harris condemned Trump's comments as decisive and disrespectful. The New York Times is reporting that Iran's supreme leader ordered a retaliatory attack on Israel. The warning comes after Hamas said Israel assassinated its political leader in an airstrike in Tehran. Meanwhile, Israel today confirmed it had indeed killed Hamas's second-in-command in a July 13th airstrike in Gaza. The U.S. is now advising citizens to avoid traveling to northern Israel and Lebanon. United and Delta suspended flights between the New York City area and Tel Aviv. Shares of SocGen are trading lower in Paris today. The bank reported a 24% surge in trading revenue in the quarter, but its domestic retail unit continued to drag on performance. SocGen cut its full-year guidance by more than $320 million for that unit. Shares are off by more than 7%, as you can see this morning and so far this year, making it one of the worst-performing European banks. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes' time. That's SocGen. Barclays. That stock is up more than 50% year to date, and the earnings were pretty good. overnight. We'll catch up with the CEO, CS Venkatakrishnan, a little bit later this morning here in New York City at about 7:30 Eastern Time. Look out for that. Up next on the program, it's all about AI.
There are all the jokes about how all the tech CEOs get on these earnings calls and just talk about AI the whole time. It's because it's actually super exciting and it's going to change all these different things over multiple time horizons.
It's basically all they do, all the time, but for good reason. And we'll talk about those reasons next. Live from New York City this morning, good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
Let's check out the scores. Equity futures on the S&P 500 firmer here by 1/3% in the bond market. After 5 consecutive days of lower yields on a 10-year, we bounced by just 2 basis points. But Lisa, we came close to breaking 4% yesterday, 4.05 this morning.
As everybody basically gamed out a Fed that has a new paradigm, and I think this was key, and Bob Michael of JP Morgan really picked this up, saying the commentary that right now it looks like there is a balance of risks, that their mandate is balanced between employment and inflation. The removal of the inflation concern as the preeminent one sounded a huge signal to Wall Street, and they heard it loud and clear.
Huge signal elsewhere as well. We've got to mention this NVIDIA rally. The biggest one-day move, biggest one-day addition in market cap in the history of US markets. $329 billion added to NVIDIA yesterday.
And this goes to the point that we were making yesterday, which is that AMD earnings really signaled this huge CapEx investment cycle. And every earnings report that we've heard from, whether it's Google or whether it's what we heard from Microsoft, is massive investment. So at this point, NVIDIA is still the winner of a cycle that really is at its beginning stages in terms of application.
The stock is up by another 0.9% in early trading. Under surveillance this morning, it's all about AI.
There are all the jokes about how all the tech CEOs get on these earnings calls and just talk about AI the whole time. It's because it's actually super exciting and it's going to change all these different things over multiple time horizons. At this point, I'd rather risk building capacity before it is needed rather than too late. As we scale these investments, we're of course going to remain committed to operational efficiency across the company.
Here's the latest. Meta shares rising in the pre-market. The company reporting better than expected sales for the second quarter, offering some evidence that the tech giant's push into AI is paying off. Scott Devitt of Wedbush lifting his price target to 600 from 570, writing this: "We think spending levels are justified given the benefits AI is already bringing to the business and the considerable optionality for Gen AI products and services longer term." Scott joins us now for more. Scott, it's great to catch up, sir. I want to talk about that quote from Mark Zuckerberg and put it together with a quote we also got from the Alphabet CEO about a week ago, when Sundar turned around and said, it is better to overinvest in this than risk underinvesting in this. And Mark Zuckerberg said, at this point, I'd rather risk building capacity before it's needed rather than too late. Scott, what is the urgency here? Can you speak to that? What are these CEOs talking about?
I think CEOs recognize that the opportunity in AI is more significant than the opportunity that existed in the internet 25 years ago. And so there's a small number of companies that have the capacity to be able to try to get ahead of this and to build capabilities in front of it, you know, as the monetization comes down the road. And I think that that's the consistency that you hear from each one of the CEOs, you know, Alphabet, Meta, you hear that from Microsoft and Amazon and Apple as well.
I do wonder, Scott, about whether this is actually an application difference for Meta or whether it's just a messaging difference from, say, Google in terms of how investors received their spending. It really was interesting to me that Mark Zuckerberg talked a lot about how they're using artificial intelligence and creating more targeted advertising. Was this a sort of lesson that was learned from Sundar Pichai and the others, basically saying you got to show a little bit more about how it's being monetized?
It could just also be the timing of the day. You know, sometimes markets move in weird ways independent of what's happening in companies. And Alphabet's quarter was actually quite good with the exception of some weakness at YouTube, but otherwise it was broad strength in the business. And, you know, with Meta, there were some company-specific issues from last quarter because Zuckerberg did say that the company was going to increase AI spending without any defined monetization. And so when you got to this quarter with Meta, you had these concerns that were building that have been, you know, broadly disseminated now around the ability to drive returns, not just spend money on AI. And then you had the Meta-specific dynamic of that company having done just that 1 quarter ago. Then Meta beat revenue estimates, beat operating income, guided to operating expenses for this year being constant, and then only raised the low end of its CapEx guidance while guiding into a harder comp period for revenue in the third quarter that has a high end of 20%. So they kind of checked every box. And then Zuckerberg got on the call to start mapping out some of the areas where AI starts to impact the business, even though it's longer duration in nature. When you begin to build that visibility, I think investors get more comfortable.
I just have to say that when Meta reported that they had 3.3 billion users and that it was up 7%, I'm thinking, at what point are they going to run out of room to grow, considering the population of the United States and beyond? I am wondering, Scott, just looking forward to Amazon and Apple reporting after the bell today. What are you looking for in terms of CapEx, in terms of AI spend, and what will be rewarded and what will be punished?
CapEx will be up and likely higher than expectations. I mean, that's going to be a theme that that really stays around for some time. I think as an investor, what you want to see is health in the core businesses and this mapping of how each individual company is going to address the AI opportunity. In the case of Amazon, I think what you're going to see is strength in the retail business, strength in the advertising business, and an improvement in AWS. With increased spending. How that's received, my expectation is it's going to be positively received because Amazon's finally clicking on all cylinders again after a period of transition post-pandemic.
Scott, operational efficiency was a phrase that was used by Mark Zuckerberg again at a time that they're spending all this money on investment. Can you speak to how much wiggle room they have on cost still, how efficient, how disciplined that company still is?
So Meta cut a lot in that post-pandemic year of 2022 when everyone started to become more efficient on the digestion period of the overbuilding from the pandemic. And so I think Meta has more to cut, but I think what's interesting is AI itself brings the ability to manage costs and make your employees more efficient because there are coding benefits that benefit software developers. Zuckerberg mentioned last night the ability to be able to just provide budget and business objective as an advertiser, and that Meta can actually do the work with AI to provide the advertising that one needs, and that provides a level of efficiency as well from an ad sales and from a customer standpoint, the advertisers themselves and their integration forces to provide lower costs really across across the industry. And so I think Meta will be a significant beneficiary of that, and that's not something that's really anticipated.
Hey, Scott, this was great. It's good to catch up. Scott Devitt there of Wedbush on the latest with Meta. That stock is up in the pre-market by something like 7%. Up next on this program, we'll speak to John Lieber of Eurasia with tensions rising in the Middle East. That's just around the corner. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
Especially I'm afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
I have to say, in the last couple of days, there's been a lot of bears on this program. So let's hear from a bull, Stuart Kaiser, Citi. The foundation of equity markets remains sound, strong payroll growth, easing inflation, solid GDP, and FOMC cuts on the horizon limit downside. That's what Stuart Kaiser over at Citi's got to say. As for the payrolls piece of this, we'll see that Friday morning, tomorrow morning at 8:30 Eastern Time. Going into it, the scores look like this on the S&P 500, elevated by 0.4%. On the NASDAQ 100, up by 0.5%. We said this at the start of the program yesterday. At one point, after the close on Tuesday, the NASDAQ was heading towards its worst month of 2024, and then the bounce happened yesterday. And it was quite a big bounce on the NASDAQ 100.
Are we allowed to say it's the magnificent one, that it's just NVIDIA that kind of powers through everything with more than $300 billion of gains in one day? That is a record in terms of a single day gain for any stock, which really shows the resilience of the many cylinders. By the way, we have had a lot of bears in this program, but all the bears are still buying. It's just that they're not necessarily seeing the rotation as significant as other people.
Whose phrase is reluctant bull? I can't remember. Reluctant bull. That's a phrase I heard earlier this year. Reluctant bull. I have to say there are a lot of reluctant bulls after the rally we've seen, particularly small caps over the last month. Let's switch at the board, turn the page and get to the bond market. I want to focus on the 2-year piece of this and the 10-year piece of this. The 10-year has had a 5-day rally coming into Thursday, and over that period, the 10-year yield is down by 25 basis points, including a double-digit move in yesterday's session. We were down to just north of 4%. We're higher this morning by 2 basis points to 4.05. Lisa talked about the performance in the month of July, a 50 basis point move lower at the front end of the curve on a 2-year. It's a small bounce to kick off August. Yields are up 2 basis points. So let's call it 428, but that's quite a rally at the front end of the curve, Lisa, through last month.
There has been a huge adjustment in not only when the Federal Reserve will start cutting rates, but how deeply they may cut rates based on the fact that we have seen real deterioration in the labor market. There was a nod to that, maybe not as much as some people would have hoped, by Fed Chair Jay Powell. I'm glad that you really are focusing today on the 10-year yield and the rally there. Why? And maybe it's because when we hear commentary from people, it's a process. It's the beginning of a series of rate cuts. We heard that from Rich Clarida. It is not the one and done that Raphael Bostic sort of hinted at just a while back.
Over in Japan, they're hoping it's not the one and done. They're hoping there's more to come. Switch out the board and get to dollar yen. The move we saw in dollar yen yesterday, we just closed out July. Dollar yen finished the month down almost 7%. It was the best month we've seen for the Japanese yen since 2022. We are just north of 150. We had a brief break of it in yesterday's session into the close. And Lisa, you wonder, the Bank of Japan, does it get what it needs? And that's more rate cuts from the Federal Reserve.
And do they have to go again themselves, right? Because they did leave on the table that they were going to potentially cut rates again. They got the perfect kind of outcome. A Federal Reserve that at least was interpreted as being on the more dovish side and allowing the dollar to weaken, at the same time that they surprised markets by hiking rates and cutting their bond buying. Do they have to move again, or is this enough to really give legs to pushing out the carry trade that really has been pretty dominant?
That's the Japanese yen. If you go back to that board, on that board is a currency pair. It's cable. It's the pound against the US dollar. The pound just a little bit weaker. Going into this Bank of England decision in about 27 minutes' time. We'll give you a preview of that in just a moment. As for the euro, negative by a third of 1%, 107.88. SocGen called the decision to cut interest rates of the ECB data independent. And yesterday, slipped under the radar because so much was going on, hot CPI out of the Eurozone. I wonder what the Eurozone and the ECB has in store for us in the next couple of months.
It was something like 2.6% versus the expected 2.5%. Again, when does this become sort of the main story again at a time where they're looking at weakness, they're looking at a Germany flat on its back? And that really raises the question, and the reason why the Bank of England is going to be so important. Do they join the ECB? Do they join the Riksbank? Do they join the Bank of Canada in beginning their rate-cutting cycle, even though inflation still appears to be sticky on the margins? Bank of England sees less sticky inflation than, say, the Euro region as a whole, but this really is sort of the angst when they're facing off with growth concerns that are much more significant than the U.S.
Under surveillance this morning, let's get to that story. The Bank of England rate decision just under 30 minutes away. It's the third major central bank decision in just 2 days after the BOJ hiked rates and the Fed held steady. Economists surveyed by Bloomberg expecting the Bank of England to cut rates by 25 basis points in about 26 minutes' time. I remember the first hike. Do you remember the first hike? Because I phoned in. I was on vacation. I called it a year. And I remember the conversation you and I had. And when we talked about it, we said the important thing here wasn't the first move, it's what happens next. How far are they going to have to go? And I think the same applies to coming down in the other direction. The big move isn't this one at the top of the hour. The big move is what happens next. How far did they take this? And I think the question we asked at the top of the program, are we truly in a new regime of higher inflation or not? And how does Governor Bailey think about that? Because Chairman Powell, I think, gave us enough clues yesterday as to how he thinks about it. He was pretty clear, I think. He thinks that the shock we've seen was transitory due to one-off factors, and we're working our way through the other side, and things might go back to normal.
What I find interesting of the Bank of England is that they are more directly exposed to potential political risk, especially with a new government and new fiscal policies that are trying to get the fiscal backdrop into order. I say this because the Liz Truss moment was really what caused the Bank of England to also have to respond. And it raises this sort of specter of, do they have a fiscal policy, like Loomis Sayles says, that is strong enough that can provide pound strength even as they cut rates? That is sort of going to be the interesting dichotomy at a time where they do export and import so many goods that a weaker currency makes their inflation problem that much more difficult. So from the Bank of England's perspective, how much is that path determined by fiscal policy much more than they would otherwise like?
You mentioned the Liz Truss moment. This Liz Truss moment is haunting governments, and it's become a self-imposed debt brake on the likes of the United Kingdom and other governments, I would suggest, across Europe as well. But I would ask this, how skeptical are you of that? Do you think it's haunting them, or is it a convenient reason to pull back in certain places? Does it become a convenient political excuse to do the things that they actually want to do?
Doesn't matter, I would say. A lot of people say the reason why we haven't had a debt problem in the United States is because people worry about it. It's sort of the justification for the people who like to worry a lot about everything. You matter because you're actually causing some sort of restraint. You know, if it's imposing self-restraint and it's a convenient excuse, well, it's working. I'd flip it around and ask the question, is the currency market responding to the threat of a Liz Truss moment as being an effective guard from fiscal policy having extreme profligacy? And that maybe is going to be the real question, especially when you look at the pound and how it responds to a possible Bank of England rate cut.
Getting closer and closer back to 130. I'm totally with you. I just wonder if the same rules apply to the United States in the next 12 months. And no doubt we'll talk a lot about that around this table repeatedly for the next year and well beyond. Let's turn to Meta. Shares of Meta rising in the pre-market. It's a decent rally at that. The company reporting better than expected second quarter sales, showing evidence that its push into AI is paying off. Max 7 earnings continue later on today. We'll hear from Apple and Amazon after the closing bell. But I want to sit on Meta and that line from Mark Zuckerberg. At this point, I'd rather risk building capacity before it's needed rather than too late. The line we heard from Alphabet, similar story. The risk of underinvesting is greater than the risk of over-investing, and supporting some of that. Where is this capital coming from? Later on this morning, in about an hour, we'll catch up with Apollo's Jim Zelter, and this is going to be a big, big theme. How much spending are we going to see? How much investment will we see in this area over the next couple of years?
And how much is private capital helping to finance it? Because guess what? Even if there is overinvestment in certain corners, overall, as many of these executives are saying, it's better to be overinvested than underinvested. With Meta, they did outperform on just sort of the headline, top-line numbers. They also signaled use cases for AI that were actually making them profitable, like using it for more targeted ads. I think that also was a differential for them.
Yeah, that's helpful.
Alphabet.
When you're just direct about like how it's helping you make money.
Correct.
Right now.
What it is.
Let's turn to the commodity market. Crude rising for a second straight day as tensions mount in the Middle East. The New York Times reporting Iran has ordered a direct strike on Israel for what it says was the assassination of a top Hamas leader in Tehran. John Lieber of Eurasia Group joins us now for more. John, I want to talk about leadership and the lack thereof. Where is U.S. leadership in this story in the last couple of days?
I mean, the U.S. just has very little ability to influence Israel here. You've got domestic pressures that are pushing the Israeli leadership to retaliate against the Hamas for the attacks of October 7th. And what's happening is they're clearly more risk accepting than we would have thought a week ago. But the fact of the matter is that nobody really wants a regional war here. Not Iran, not Hezbollah, not Israel. And you want to talk about U.S. leadership, that's probably where U.S. leadership is projecting itself, is in their ability to credibly threaten they're going to come in and back Israel here. And a war is a losing prospect for all sides. So the U.S. is leading through its ability to deter Iran from overreacting to these very provocative actions by Israel. And that ultimately is one of the factors that's keeping this regional conflict in check right now.
John, the U.S.'s approach to Israel has seen an unprecedented divide between the Republicans and the Democrats. And a lot of Democrats, particularly on the more progressive wing, were pretty angry with Joe Biden over his policy toward Israel. Is your sense that Kamala Harris has effectively separated herself from that and created her own platform?
Yeah, I think Harris is able to generate a lot of enthusiasm among the Democratic base. And that's for a lot of different reasons, some of which are just the fact that she's not 81 years old and probably has a path towards beating Donald Trump. but some of that is based on policy. And Harris has been the face of the kind of more skeptical part of the administration towards Israel. That's not to say she's not going to support Israel. That's not going to say that Israel doesn't continue to have, wouldn't continue to have strong support from the United States in a Harris administration. But she has been the bridge to the progressive wing of the party on this issue. And I think that's causing a lot of the progressives that were very unhappy with Biden to simmer down for now.
John, you said that she is producing some sort of real counter case to Donald Trump and has the real potential to win. This is actually causing the Trump trade to unwind, whatever the Trump trade was, even though some people might reject that it was ever a trade, or the validity behind it. I am wondering, do you think that there is a material shift in Kamala Harris's odds versus Donald Trump over the past couple of weeks, and especially after yesterday, his interview with the National Association with Black Journalists?
Yeah, after the assassination attempt, I think the consensus was pretty well baked in that Trump was on the path to for an electoral college blowout in this campaign. And that consensus made sense to me. Biden just could not prosecute the case against Trump. And what we've seen since the switchover from Biden to Harris is suddenly you've got somebody that can articulate all the things that the Democratic Party doesn't like about Trump and all of his vulnerabilities. She's using her record as a prosecutor to make a contrast with his criminal convictions. And Trump himself is not doing really doing himself any favors right now, making kind of the types of missteps and controversial statements that he made that were very common in 2016, which is, of course, a race that he won. So I think Trump is a bit savvier than maybe we give him credit for. But right now, the momentum is on Harris's side, and her odds have materially improved over Biden, even though Trump still has more paths to win this through the Electoral College.
John, after the assassination attempt, a lot of us asked the question how the Biden campaign was going to pivot, and would they have to move away from a central message of their campaign? In fact, the only message of their campaign, which was to characterize the former president as an existential threat to democracy. And the intriguing thing for me over the last week, John, is that actually the campaign has shifted, it has pivoted. You don't hear much of that from Kamala Harris at all. In fact, I think what Harris is offering, and I'll say this up front, I would like to see her sit down and do an interview and answer some questions. But what the campaign at the moment has offered, and I'm sure that will come, is the opportunity to turn the page on the politics of vengeance and retribution. And what I saw yesterday in that room with those journalists and the former President Donald Trump was a man seemingly struggling to do that, John, and the campaign afterwards going into a rally, struggling to move on and struggling to pivot, struggling to change the message, struggling to work out how to compete with Kamala Harris. John, how's that going to change in the weeks and months to come?
Yeah, I think that's spot on. And I hope Harris comes on your show for an interview. I'd love to hear what she has to say. But I think the Trump campaign was clearly caught flat-footed by this shift. You know, you've gone from saying that Trump's a threat. The Democrats have gone from saying Trump's a threat to democracy to saying that he's weird. And honestly, that's probably a better message that resonates with more voters because they do say a lot of weird things, including at that black journalist event yesterday. And I don't know what the Trump campaign is going to do. I think they were really, really, really well prepared to take the fight to President Biden and just don't know how to articulate a case against Kamala Harris. Now, this will come. I mean, Harris has a record in public office. They're going to say that she was a California progressive, the most liberal senator in her time there, and they're going to say she was an incompetent vice president who screwed up the border. They've kind of trotted out these messages already, and they're just not landing right now because of the enthusiasm that Harris is getting. So the question, one of the big questions going forward is, can Trump be the disciplined, effective campaigner that we've seen for, basically 6 out of 7 months this year, and turn that case around and make the case against Harris that she's to blame for these Biden policies, she's out of touch with the American people, et cetera? Or do you see Trump continue to flail and kind of make these really wild remarks, which are, I think we should point out, targeted at black audiences? I mean, he has a target in mind for what he's doing, and it's an electoral target that he has. He's trying to discredit her with black voters. And that's a strategy. It may work, it may not. But I think Trump is one of the big wild cards, as he has been for a long time in this election.
John, appreciate your view. As always, John Lieber there of Eurasia Group on the latest development, not just in the Middle East, but here domestically in the United States. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. The Democratic National Committee says Vice President Harris is the only person qualified for the Democratic presidential ballot. Harris has secured the support of 99% of participating delegates since entering the race less than 2 weeks ago. As for the timeline going forward, the virtual roll call that makes Harris the official nominee will run from today until the 5th. Harris is then expected to announce her running mate by the 7th. Then 12 days later, the party holds its convention in Chicago the week of August 19th. Bloomberg has learned that Applied Materials will not be receiving U.S. funding for a long-anticipated research and development center. Sources tell us the U.S. Commerce Department rejected its application for $4 billion in CHIPS Act money, saying that the project did not qualify. Applied Materials has said the California project would be the industry's biggest R&D facilities. And shares of Barclays failing to hold on to gains, down this morning after opening higher by 3%. It reported better than expected investment banking revenue in the second quarter. The British lender also announced a $963 million buyback and upped its guidance for the full year. Coming up in about 30 minutes, Barclays CEO C.S. Venkat-Krishnan will be joining John and Lisa for a live interview following those results. John, looking forward to that one.
So am I. Danny, thank you for that. We'll catch up with Danny again in about 30 minutes. It's quite a lineup for you. We'll catch up with Jim Zelter of Apollo. Their earnings are just out. We'll catch up with him in about 30 minutes. 15 minutes after that, we'll speak to the Barclays CEO, C.S. Venkat-Krishnan. And then after that, the former Kansas City Fed President Esther George on the Federal Reserve decision of yesterday. So that's the next 60 minutes or so on Bloomberg Surveillance. Up next on the program, if the answer's September, what's the question?
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market.
That conversation up next. You're watching Bloomberg TV.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Equities on the S&P 500. Following through from the gains of yesterday, some positive follow-through. We're up by 0.4%. Yields are higher on 10-year bonds, up by 2 basis points, 4.05% on a 10-year, after drifting lower. I say drift, kind of plunging over the previous 5 days, down by 25 basis points over that period. Under surveillance this morning, if the answer's September, what's the question?
The question will be whether the totality of the data, the evolving outlook, in the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
So here's the latest. The US jobs report tomorrow, kicking off a quartet of key data points ahead of the Fed September meeting, with 2 more CPI prints and another jobs report coming before the central bank meets once again. Jonathan Pingle of UBS writes this: the FOMC is unlikely to lower rates at an every meeting pace at the start of this process unless the risks to the labor market are more severe than we currently assess, or a much sharper drop in inflation than we currently project. Jonathan joins us now for more. John, it's good to see you.
Good to be here, thanks.
Let's get to those comments from Chairman Powell. I'll go through it again. It's about the totality of the data, the evolving outlook, and the balance of risks. Haven't we met that test already?
I think we probably have. I mean, I think that the way Chair Powell, he fielded those questions pretty depthly. The totality said he wasn't going to hinge on any one data point. So it really does sound like they're there, right? I mean, barring some huge surprise, I mean, it sounds like the September rate cut's basically a done deal.
It raises a question about whether the market is too enthusiastic about what comes next, because we've been talking about a potentially shallow path of rate cuts, and suddenly markets were basically saying, just kidding. Actually, they're going to cut quite a bit, and they're going to cut quite a bit this year, potentially even more than one 25 basis point rate cut at the September meeting. Do you think it's gone too far?
I do. I mean, we're expecting 2 25 basis point rate cuts, one in September, one in December. But I do have to say, I was a little surprised in the press conference with Chair Powell's general comfort with market pricing. I mean, he was asked, he got a chance to push back, and he didn't. And the market is pricing fair odds of a cut per meeting for the first 4 meetings, which is very different than what we've seen, say, in the SEP or the other communications.
Which raises this issue of whether he represents the committee, whether he is sort of an independent and much more dovish actor. Do you get the sense that in Jackson Hole there is going to be a very different set of potential rate cuts laid out in terms of their vision of the neutral rate and their vision of how quickly the labor market is weakening?
I do. I think we're going to get a very specific message from Chair Powell at Jackson Hole that is going to lay out what comes next, sort of what is after the September rate cut. And I think that